We have exceptional panel here with diversified experience. During our discussion, we will have you will have the opportunity to send your questions via the phone application. I will say a few words before we start with the discussion. Oil exporters now, they are in a new era of prolonged low oil prices. We've seen oil prices declining in 2015, and they have stayed pretty low as compared to the previous years. So most oil exporters in the MENA region and elsewhere are facing major challenges. We saw growth rates in Middle Eastern oil exporters declining from an average of 6% to 2%, and the prospects doesn't seem that encouraging. The question now is how oil exporters will cope with such an environment of prolonged low oil prices and escalation of tensions in the Middle East, which is affecting private sector confidence in the form of lower investment. Also, given lower oil prices, our projection for next year is $58 per barrel. It could be lower, given the supply glut. Policymakers in the region are facing a dilemma. Would they resume fiscal consolidation or keep a certain fiscal expansionary stance so that growth rate doesn't drop less than 2%? In some countries, for example, Saudi Arabia, growth rate, non-oil growth rate is 2.5, maximum 3%, which is not enough to create enough jobs for Saudi nationals, where unemployment rate in Saudi Arabia is 12.5%. Another issue that we will touch on is the diversification away from oil. There has been plans by several countries to move away from oil. What were the progress made? What are the constraints? Is the fixed exchange rate in the region, which has been pegged for more than 20 years, about 30 years, a constraint for diversification? So we will touch on these sensitive issues and also on the geopolitical environment. With that, I would like to start with Alia. Alia, in an era of prolonged low oil prices, how you see the challenges and opportunities for the MENA region? You could also touch on the geopolitical risk and the spillover effect on other economies in the region.
Sure. Thank you very much, Gabrice, and for inviting me to this distinguished panel. I mean, obviously, I think it goes without saying that the structural transformations that are happening in the global oil markets are have had over the last 5 years and will probably gonna continue to have a significant impact on both our day-to-day assessment of the risk of this region, but also on its outlook in the future. I think the key issue the key reason why is that because we have come to this realization that this oil shock is not of a temporary nature anymore, but rather it is of a permanent nature, and that requires a significant adjustment. Even in the markets where I sit and where financial market participants were squarely focused on oil prices and oil price volatility in terms of their assessment of risk, cannot ignore anymore what is happening in those countries in terms of the reform momentum and the agenda for reform to do such an adjustment. And that brings me to the challenges and to the opportunities, because clearly the challenges are what we saw in terms of impact over the last 5 years and the kind of policy response that the governments have taken. So in the terms of impact, we have seen, as you mentioned, Gabrice, growth slowdown, disappearance of surpluses and widening of fiscal and current account deficit, but more importantly, again, from my perspective, sitting in financial market, a very rapid accumulation of debt that could, in some countries, threaten or have heightened vulnerabilities, and therefore could have significant spillover on financial stability in those countries. But I think what is more interesting is the response that we have seen. The response in many of these countries, at least at the beginning, was very fast, front-loading much of the fiscal adjustment, whether in Saudi Arabia or in some countries in Oman at the beginning. But then we have seen a fading of this basically momentum for reform. And I think one of the key challenge today is particularly as we are also in a period, and we're going to talk about it, where oil prices are not actually increasing despite higher geopolitical risk, where basically we will have to reassess how deeper and broader we will have to go into the fiscal adjustment path. The second challenge, of course, is the challenge of growth. I mean, growth in much of the region has been anemic, and in those countries, particularly, you mentioned Saudi Arabia, but I think we should not forget Oman, where youth unemployment and the demographic dynamics in Oman are actually even more biting. There is no fiscal space for relaxing the pace of fiscal adjustment, and therefore, and particularly that private sector activity is subdued. So the challenge today is how can we create more space for private sector in order for it to become a major driver of growth. And one last challenge, obviously, but this mainly applies to countries in the region, to oil exporters with high level of debt and external vulnerabilities, and that is again Oman and Bahrain, where debt levels are around 90%, is about really the story of reform. Is do you have a medium-term fiscal adjustment plan and growth plan that actually can help you reduce the vulnerabilities? And we saw a very important effort on this front by the Bahrain government with the introduction of the fiscal balance program that we hope, as TIS, in terms of a financial market participant, that could be followed through in the rest of the region, and particularly in Oman, where the fiscal adjustment has been really very slow given the large deficit. In terms of your second question, and I'm sure we can come back to the points I've mentioned, on opportunities, I think the key opportunities in a lower oil environment is the opportunity of reform. I think even if we have not yet created the culture in many of these oil exporters for a demand-driven type of reform, I mean, in the sense that it comes from domestically, because of the nature of the social contract, we are not seeing this kind of reform still developing. But certainly lower oil prices should be this impetus to engage a wider set of stakeholders in society, in the private sector, in what should be the path towards growth, diversification, and sustainable fiscal adjustment. I think that is the key opportunity. And the second opportunity, of course, is the opportunity of reducing geopolitical tensions, because I think in an environment where there is a tighter liquidity, bigger deficits, I think trying to alleviate the cost of a Yemen war on many countries' budget would be certainly a benefit, because you can allocate the resources somewhere else. But also more broadly, it can the opportunity of reducing geopolitical tension because of lower tighter budget could have spillover not only on the oil exporters themselves, but on the rest of the region.
Yeah. In that context, Adnan, what is your perspective on the current political environment in the region? And another thing, maybe you could tell us what's happening in Iran, given the US sanctions. In the past, even last year, the economy contracted about 5%. This year could be more than 6%. How they are coping with the sanctions, and at what point they will say that's enough, we have to sit and renegotiate the nuclear deal?
Thank you very much for having me, and good afternoon, ladies and gentlemen. I think Alia started nicely on the long-term trends in the oil markets, which I would also reinforce by something that I learned more and more talking to both country authorities in the consumer countries and to the private sector, and that is the fear of decarbonization that they have. Okay? So it is not just a question of declining prices. It's a question of ending up with stranded assets pretty soon. So the long-term fundamentals of the oil market are not good. These trends are reinforced by the short-term prospects of a global downturn. This would mean a few things for the oil producers. First, which is not an easy thing to say, especially if you're from the region, especially if it's even more harder to hear, which is we're not as important as we used to be. Okay? And this is reinforced by the current the way that the US foreign policy is managed. It also means that if there are problems in the region, there will be weaker global crisis resolution frameworks. For example, if there's something going on, you won't have another perhaps very quick resolution by the G8 to help the region after they did after the Arab Spring. However, this departure of the rest of the world from the Middle East and looking away from the Middle East could present some useful dynamics in the region. That, of course, the rest of you are always thinking that we in the Middle East have proxy fights among each other. But we also have tried to have a proxy fight where we get the US to do our fighting for us, right? And the US is moving further and further away from playing that role. So especially the oil producers of the different sides of the Gulf are now learning that they may have to sit together and talk. And you've seen some useful interactions between the UAE and Iran and Saudi Arabia and Iran. And hopefully the first result of this will be to end this horrible, utterly horrible war, war in Yemen. On Iran, my bottom line is as follows. Sanctions have done tremendous damage to the Iranian economy, but not as much as people had thought. In fact, despite some really bad policies, especially in the area of foreign exchange management, the economy has not collapsed, and in a few areas it's actually stabilized. There has been tremendous damage to the oil exports, to the balance of payments, and to the budget. Of course, there was a huge pickup in the value of the dollar against the rial, the Iranian rial. But in the past few months, the Iranian rial has appreciated about 40% with tighter controls, okay? And also some sense that the risks of a military conflict in the Middle East, especially between the US and Iran, are not as high as people used to think. But of course, growth has been hit very, very badly, especially because of the interruption of supply chains. Last year, growth economy contracted close to 5%, and this year it's going to contract about, according to the projections announced yesterday by the IMF, about 9.5%. Okay, and inflation, which is slowed a bit right now, is still running at a rate of 43%. Social conditions, of course, as you can imagine in this situation, are hurt very badly. Poverty and income distribution have deteriorated significantly. But while these conditions are not sustainable, I don't see a collapse in the short term. First, Iran is a diversified middle-income country, and there's a large quantity of non-oil exports. And except for this really bad policy that they had on the management of the exchange rate. Other policies have been rather conservative. For example, the budget is shrinking this year significantly in real terms. And the population has shown a significant degree of patience for punishment, unfortunately. Now, Iran's key concern is naturally right now how to get around the sanctions. Okay? I think they are open to a modification, amendments, or a new nuclear agreement plus. But the way that the US walked away from the nuclear treaty has raised the political cost of anybody in Iran to sit down with the US again. And if it doesn't, the sanctions are hurting so much that they feel they need to ratchet up the pressures in the Gulf on oil markets if there's no relief from the sanctions. Okay? But it's also important to remember that any reform in Iran, and there are some little bit signs of it, I'm not very optimistic, will be made very difficult because of the divergence of views, of course, in Iran itself.
Thank you, Adnan. Moving to another region, Latin America. Francisco, how the oil exporters in the region are coping with low oil prices? Although, I mean, the dependency on oil in Latin American oil exporter is much less than in the Middle East. Maybe you could also touch on Venezuela, the implication of the sanctions where production dropped almost from 2.5 million barrels a day now to less than 1 million barrels a day. At what point things will reverse in Venezuela? I'm speaking about the scope for some kind of agreement maybe, or a change in regime which could lead to some recovery in oil production.
Sure. So compared to the previous, crisis in the 80s when the price of oil collapsed, this time most Latin American commodity producers have fared much better. They were more prudent this time. But that doesn't apply to Venezuela, which has been, of course, an outlier, a crazy case in which we have the largest drop in GDP in recorded history in Latin America, in Venezuela currently. And this is even before the sanctions. It was already the case. And, hyperinflation and a very difficult situation. In terms of the oil industry in particular, production has declined about 2 million barrels per day in the last 4 years to less than 700,000 barrels today, and that has been a big help, for OPEC in terms of the effort to sustain prices. Venezuela and Iran have done all the effort, not that they wanted to do it. And since sanctions started, particularly oil sanctions at the beginning of this year, production has halved from 1.3 million barrels to about less than 700,000 barrels. And today Venezuela is facing a situation in which it's not being able to sell the oil. It's accumulating massive inventories, close to 50 million barrels of inventory for a country that produces barely more than 500,000. And the only reason why it's not even worse is because Russia, particularly the national company Rosneft, is helping Venezuela market the oil. About 2/3 of the Venezuelan oil are being marketed by Rosneft to India and China. So can Venezuela recover? I mean, the geological resource base is amazing. It's concentrated in extra heavy oil, but there is also significant conventional potential, and it's clearly possible that if there is a transition, Venezuela will significantly recover oil production, but that will require very significant investment, much more than in other countries that had to recover from drops of this nature. So the estimate is about $120 billion to recover production to the levels that it was before this collapse to about 3 million barrels, and that could take anywhere from 7 to 10 years. So it's not going to be immediate. There is going to be some spare capacity at the beginning, because currently the restriction is more about selling the oil than producing it. But the oil industry is such a bad shape that even though there are these big opportunities, and the foreign companies that are already operating in Venezuela can contribute to significant increase in production in the short term, and the oil industry will be open up, at least if you believe that currently the opposition is going to be back in power. So that will be another challenge for the price of oil in the future, because Venezuela will certainly become a player again in that scenario.
In fact, I mean, the risk or the possibility for that to happen is small, even in case of Iran renegotiating the nuclear deal. Is still far away. It could take maybe 1 year or so. But if that happens, then you will have a glut of supply in the oil market. And I am surprised that investors now, they are only looking at the slowdown in the global demand for oil because of the slowdown in global growth. In fact, there the change is marginal, probably 500,000 barrels a day, 0.5 to 1 million barrels a day, if you have a classical recession. While on the supply side, it could change between 1 to 3 million barrels a day. And then you might have a situation where oil prices could drop well below 60 or even to around $50. And that has major implication on the oil exporters. Radwan, moving to other group of countries in the MENA, the oil importers. MENA oil importers, they benefit from lower oil prices in terms of lower import bill. But there are other linkages with oil exporters. Could you elaborate on that?
Yeah. Absolutely. Actually, the immediate direct impact of lower oil prices is beneficial to the oil importing countries everywhere, including in MENA. And that comes most readily from lower oil import bill, which improves the current account balance, and that can be visible across all the countries. At the same time, because energy products are subsidized in many oil importing countries, Lebanon, even though less, but they continue to be so, Egypt, Tunisia, Morocco, lower oil prices means an improvement in the fiscal balance. So on both of these counts, the immediate impact is beneficial for the oil importing countries. At the same time, to the extent that energy prices are reduced, you have lower production cost and you have a higher consumer disposable income. Now, the other set of, which are a bit less obvious and particular in a sense to the MENA oil importing countries, is that the welfare of those economies is very closely linked to the welfare of the oil exporting countries. And there are indirect channels that affect the oil importing countries. Perhaps one of the first is the other side of the trade, is not only on the import side, but also on the export side. Here, let me just give an example. Jordan, which is very close to the GCC, about a quarter to 30% of the exports of Jordan are destined to the GCC economies. And in the past 3 years, those exports have declined by about 20-25%. Exports to the GCC, partly because the economies of the GCC have slowed down and the imports have slowed down quite noticeably. Interestingly, I mean, as we see some recovery in non-oil activity in the GCC, this year we are seeing signs of a reversal. It's sort of spotty and it's month by month. But in the month of July, we have a 5.7% increase in exports to the GCC from Jordan. This is an important channel. But this channel is probably less important for a country that is like Morocco, which the exports of which are not to the oil exporting, but mostly to Europe and to other parts of the world. So this is one important channel. A second one that I like to elaborate on is remittances. Remittances are very important to the MENA oil importing countries. In the case of Jordan, they're about 9% of GDP. In the case of Egypt, about 11%, Lebanon probably 12% plus of GDP. The trends in remittances are very closely linked to what happens in the destination countries where the migrants are. And in the case, I mean, here we're talking about the oil exporting countries, so let's focus on that. One recent phenomenon that happened in the past 2 years is that we've seen, as your report, Garbis, that you published yesterday, shows 1.9 million people, expatriates, left Saudi Arabia over the past 2 years. This has had a differential impact. And this is because of higher labor cost and because of, and they tend to be mostly in the construction and I mean, differential across different countries. But this, again, has affected the oil importing countries differently. In the case of, here, let me just contrast Jordan with Egypt. Egypt, which has seen a strong growth in remittances for several years, in the current fiscal year, in the 2018-19 fiscal year, I guess last fiscal year, the first 3 quarters witnessed a drop in remittances by about 6.1%. In the case of Jordan, because perhaps of the nature of the workers who work in the Gulf, it has been more or less nominally flat. So again, this is an important element for the economies of the oil importing countries. Without going into a lot of detail, being mindful of the time, there are 2 other important channels that let me just highlight. One is the well-being of the oil exporting countries. Matters for the level of official assistance that comes from to the oil importing countries. And we have seen some decline in the readiness and the availability of those funds across the board. And the final point that I would like to emphasize is the private flows of the foreign direct investment, portfolio flows, and other types of inflows. Again, these are affected by the slowdown in the oil exporting economies, the inflows into the oil importing economies. So on balance, it really depends on the country and on the relative strength of the various elements with the oil exporting countries. In a country like Jordan, probably the indirect impacts are very strong, whereas in a country as far as Morocco, probably the indirect impacts are much less. So,
Yeah.
Thank you.
Alia, how the financial market is pricing risk or in MENA in the context of low oil prices?
I mean, I think when you want to look at how financial markets try to assess risk in MENA, I think there are at least, I think, 5 elements that determine, I mean, the way markets price risk. I mean, one of them we talked about is the oil price and where do they think compared to the fiscal break-even point and the current account or external break-even point. The other, as I mentioned, is, and increasingly so, and I think this is why many of investors that are today in town in DC are trying to figure out what is the reform agenda, where are we on the delivery and implementation, and that is increasingly factored in into the risk assessment. Geopolitical risk, as you mentioned, and here whether it is about the tension and escalation or the perceived, basically now increasing perceived vulnerability of oil infrastructure to geopolitical risk. There's also, of course, the rates environment, but also in particular today for the GCC, at least most recently until September, was what we call in the market the technicals, which is basically the inclusion of many of these GCC countries and credits into the MBE index, and which have helped considerably tighten a lot credit spread, particularly both in IG space, but also for credits like Bahrain, where there's not enough bonds. But today, if you look at spread clearly, I think, and this is our personal view or our house view at Jefferies, is that the spreads in the GCC investment grade space are too tight and are not pricing in basically the kind of bad news that could come from either potentially a reduced or a de-escalation of geopolitical risk because of many, whether it is a grand bargain or whether it is Iran coming to the table or whether it is because of, as Crown Prince Mohammed bin Salman said recently about his view on the war in Yemen. These are things that could significantly impact, or because of the glut of supply, that could significantly impact low prices, and this is obviously nice price, not priced in. In addition, what is not priced in is the growth outlook and the impact of the global, the spillovers of the global growth slowdown on the region, particularly when most of these oil exporters still their export market for their oil is Asia and their links to China. In particular, that applies for Oman, but not only. So I think there is if you add to it the risk of supply, because as we mentioned, I mean, this year we have a potential coming back to high levels of double-digit fiscal deficits in some of these countries. I mean, today the region, in particular, the MENA as a whole, but mostly skewed toward GCC issuance, is issues around a third of emerging market bond issuance, and that in itself will have also will drive much of the spread widening in the coming months. So clearly there is a mispricing here that is not factoring in potential bad news and also a weakening of the technicals.
Yeah. Adnan, you recently wrote about diversification in MENA at the Peterson Institute. How you see the prospects of diversification in MENA oil exporters? What are the constraints? Now that you are not working for the IMF, perhaps you could touch about one major constraint is the pegged exchange rate in the region. If the region moves to a more flexible exchange rate, don't you think it will help the diversification process? Are the costs far outweigh the gains from moving to a flexible exchange rate?
Thank you. Look, the work that you mentioned, what I found out was that since the early 80s, MENA oil exporters have not done very well in terms of diversification, in terms of exports of goods. They've done somewhat better in terms of diversification in exports of services. For example, a place like the UAE is done fine. Second, oil exporters have increased their participation in global value chains, but at the low end. Okay. The reasons for this performance have been mainly institutional, the significant roles of the state, the political economy that is specific to oil exporters, that governments get huge amounts of oil rents and may not use them properly, corruption. But one key issue that you mentioned is exchange rate policy. By and large, oil exporters have, and there are some good reasons for this, have tried to peg their exchange rates. The benefit has been in terms of macro stability, not having their exchange rate go up and down too much with oil price movements, but this has come at the cost of hurting diversification. Okay? To the extent you want to have your exchange rate policy forever determined by the needs of short-term stabilization, you may fix it, okay, unless the fundamentals of the economies go bad. And with oil prices being the way they are, those fundamentals may be going bad too soon. But in terms of diversification, these fixed exchange rates are not helpful at all.
On that, maybe Francisco, you could tell us about the experience of Latin American countries, how they were able to diversify their economy away from oil, particularly Mexico in the 80s and 90s. What can MENA countries learn from the experience of other emerging economies, whether Latin America or Southeast Asia, in Southeast Asia, Indonesia and Malaysia, for example? What did they do that helped them to diversify their economies?
Sure. So, I mean, the cases in Latin America, except for Venezuela, who has done terribly, are different in the sense that they have never been as dependent, on commodities and particularly on oil. But having said that, all of the cases, Chile, Colombia, Mexico, that have been relatively successful in diversifying, particularly Mexico, have to do partly with having a competitive exchange rate, and they move to floating exchange rates. They also very aggressive policy of signing free trade agreements in the region. Of course, in the case of Mexico, NAFTA has been a massive pull for the country. Mexico today exports more manufacturing than all the rest of Latin America combined, which is very impressive, but it's integration with the US. And so, but I don't think, unfortunately, these cases, because of they're much less, the level of dependence being not as high, I don't think they necessarily easily translate to the GCC countries at least.
Yeah, thank you. There is a question from the audience. Given the collective agreement amongst the panel that oil prices will remain low for a long time, can Saudi Aramco pull off a 2 trillion valuation? Anyone can have it. It's related to the Aramco's IPO, where in a market that Saudi Arabia is saying that the valuation of Aramco is around 2 trillion, while many investors are saying it's between 1 trillion to 1.5. Any view on this? Yeah.
Look, even to a non-expert, like me, that seems like extremely high valuation. That's number one. There is going to be difficulty, as we see, as shown in the long delays, with finding a decent platform and exchange through which the Aramco could be privatized, partially privatized. And also there are regulatory issues in terms of disclosures that are causing problems. So, and also given the recent risks shown to the production facilities of Aramco, those all argue that the valuations that the authorities are seeking is quite rich, but the people who will decide at the end of the day are sitting across it.
Yeah. Just to finish, we only have 1 minute. I think we had a candid and constructive discussion. This degree of openness is important, particularly for many countries where you don't have transparency, you don't have candid discussion. So with this, I would like to thank the panel for the excellent discussion.